Hey, so happy Tuesday. If you were following the markets yesterday, they continue to correct and go lower. So, one of the things that you can do on the down days to make the down days not feel so bad is tax loss harvesting. And that's what we're going to talk about. And I'm actually going to show you how to do it from my Fidelity account. It's really simple and it's a way to save hundreds or even thousands of dollars off of your taxable income every year. So, what tax loss harvesting does is it allows you to take a loss on your stocks that have went down, and then you're allowed to take these losses against your taxable income every year. And so tax loss harvesting allows you to take up to $3,000 of losses every single year against your taxable income. The cool thing is that even if you have more than $3,000 of losses, those losses carry forward every year. So let's say you have a $10,000 loss, you get to claim $3,000 this year, $3,000 the following year, $3,000 again in the third year, and then to get the total of 10,000, you could do another $1,000 on the fourth year. So not only is it a great way to save money on taxes, but it's also a great way emotionally to feel like you're taking a little control in these times where you might see losses in your portfolio. So if you watched my last video, you can by now guess that I am very much a passive investor and I invest over the long term in index funds and ETFs versus individual stocks. So tax loss harvesting is amazing for a passive investor because the rule around tax loss harvesting is you can't just sell your losing stock and rebuy the same thing. That's what's known as a wash sale. So it basically washes out. So you wouldn't get any credit. Say if you lost a bunch of money in Tesla, you take your loss and then you just buy Tesla again tomorrow. Those two things negate. But if you're a passive index fund investor, all you have to do is sell your index fund and buy an index fund that is similar but not the same. And the amazing thing is that these companies that even track the same index, they do so ever so slightly different. And so I can sell a fund that, let's say, tracks the total stock market and buy another fund that also tracks the total stock market in slightly different ways that allows me to take advantage of loss harvesting, but doesn't incur a wash sale. And so I'm going to show you what that means and how to do this in this video. And this takes like all of 5 minutes to do. And so it's a really easy way to make money. So let me show you what I mean. So let's say I have a total stock market index fund with VTI. That's Vanguard's total stock market ETF. So what I would do is I would look for a total stock market ETF that's similar but not alike. The one I like to use is ITOT. So what I do is I sell VTI, and however much I sell for, I buy same amount of ITOT. And what you want to look for is you want to make sure that the fund that you're buying isn't something that's more expensive or it has a similar expense ratio and it has similar performance. And I'm going to show you how to track that in a fund's prospectus so you can get an idea of how similar they are. Because what you don't want to do is buy a fund that performs worse or has higher expenses that would eat up the benefit of a tax loss harvest. And then the other thing is you have to figure out which of your shares have actually incurred a loss. And so let me switch over to Fidelity and show you how to do this in a really simple way. Okay, so the first thing you're going to do on Fidelity is you're going to log in and then you'll go to accounts and trade. Now I will select the account that I want to do this in. And so of course, this would need to be in a taxable account because if you have money in a retirement account, that's already tax advantage. So you incurring a loss doesn't help your taxes because there's no tax to be paid right now if you were to sell out of a retirement account. But you're going to select your brokerage account. Okay, so now I'm in my Fidelity Trade View, and what you'll see here is I've selected VTI as the index fund ETF that I want to sell. So I am going to click, and this is really important. You're going to sell specific. And why is that important? Because we want to sell the specific shares that have incurred a loss. So if you're someone like me that has been buying the total stock market for a long, long time, obviously I still have profits on most of my shares. But let's say I bought shares recently, which I did in February, that have since declined in value. I'm going to sell those and then rebuy ITOT as the replacement. So once I click sell specific shares, I'm going to see all of the past purchases that I've made. So I can scroll back to see how much money I have made on specific purchases. But by looking at my recent purchases, you can see that I have lost money or I have unrealized losses from these purchases that I made back in February. So what this is showing is I bought VTI at a cost basis of $299 roughly, and since then it's went down in value. So what I'm going to do is I'm going to sell all of these. And so what this will do is it will incur a loss. So I will have realized about $488 of loss. And this is what I can put against my taxable income every year. So this is a great way to feel like I am actually making money on down days. So I'm going to click apply, and you see that I have about $5,576 of VTI that I will be liquidating to get this tax benefit. So I'm going to click preview order, and you'll see again, I sold specific lots, which is again really important because it'll make sure that I take the loss where I want it to. So you can't just sell VTI out of your entire portfolio, because if you've had profit like most people have because we've been in this bull market for so long, this doesn't work. So you you need to make sure that you select the specific lots. And I'm sure you could do this at other brokerages. Some other brokerages actually help automate this, and sometimes you have to pay for it. But for me, it's really easy to do. I mean, like you can see, other than me explaining it, it took all of 20 seconds to look at where I've had losses. So I'm going to click place order. Okay, so that was step one. I liquidated my shares that have had a loss. So that order's been placed. And now I will get that money to be able to then place another trade for a similar fund. Now, let me show you what's important here is, and I might make a little cheat sheet that might be helpful for members of the Money Monk newsletter that kind of shows some equivalent ETFs or index funds so that you're buying something similar when you tax loss harvest. Well, let me show you how to do this research on your own. Okay, so what I have done is I have pulled up ITOT, which is BlackRock's total market ETF, and Vanguard's total market ETF. Kind of a pain to find this information, but I want you to be able to understand what I look for when I'm looking for something that's similar but not exactly equivalent. So, ITOT, what we're going to look at is how they've performed with their total market return over the last 10 years. So, what this should do is it should give you comfort that over the last 10 years, ITOT has returned 11.51% over the last 10 years. And now I'm going to look at the last 10 years of Vanguard. So 11.44. Close enough. We don't need I'm not looking to, I'm not really worried about a few bips here and there. 1 year, it's very similar, 26.11 versus 26.03 for VTI. And then actually over the 5 year period, VTI actually was better. Now, here's the part that is really important. I always look at return after taxes on distribution, because what this means is, these funds, they pay out dividends typically every quarter. And what you want to make sure of is that they are reinvesting them in a tax efficient way. And so you'll see a drop in return after obviously taxes, but sometimes it's worse in some funds than others. They're not as tax efficient. And that's one reason that I like trading with ETFs versus mutual fund index funds. And I'll get into the differences there on a future video, but it's not really that big of a deal either way. But what you can see is that actually ITOT over all periods but the 5 year period was actually more tax efficient. The returns were better after tax than VTI. So all this tells me is that I feel comfortable selling VTI and buying ITOT. And while we're here, you can scroll through prospectuses. This is really easy. Just search for the ticker symbol and then prospectus, and it's going to always show you this information. You can see that the calendar by year returns is pretty similar in both funds. And then always you want to look at the expense ratio of a fund, which is typically at the top. Yeah, so there's our management fee, ITOT 0.003, and then Vanguard total annual fund operating expense 0.03. So they're practically equivalent for all intensive purposes. Okay, so then I feel comfortable buying ITOT, and I'm going to show you how to do that with Fidelity. Okay, so now I am in the trading view for my Fidelity account, the same one I sold my VTI shares. I wanted to show you this. So what you'll see is cash available to trade is different than my settled cash. And so cash available to trade means that I have initiated my sell order and I can actually use those funds to place another trade. So the cash isn't settled, but Fidelity is nice enough to let me trade with that. And I'm going to click buy. Now, I don't know how many shares I want, but I do know how many dollars I wanted to buy. And so I knew I had $5,580.57 from this trade. I'm going to click apply. And so what you'll see is that it's going to order me about 45 shares. And now I will click place order. And once I place the order, that trade goes through immediately. Cool thing about exchange traded funds is that you can trade them in the middle of the day. So unlike mutual fund index funds, which only trade at 4 p.m. every day, I can do this tax loss harvesting in the middle of the day and move on with my day. I don't have to wait two or more days to have all of this processing. So I love ETFs. I'll talk about the pros and the cons in a separate video. For the most part, very similar. So don't sell out of your passive index funds to buy passive ETFs if you have mutual fund index funds today, but ETFs just add a little bit more convenience. And so it's what I prefer. So I'll click place order. And then from there, I will have tax loss harvested. All right, so closing comments. So now I can use this loss on my tax return this year. I will be able to offset my taxable income by the amount that I lost. And so let's say I had an even larger taxable brokerage, I could just continue to do this. So I don't know if the market's going to go up today or down today, or maybe it'll crash over the next week. Well, what I'll do is I'll just keep tax loss harvesting. So the more losses I incur, the more tax gains I'm making. So again, this is a great emotional way for me as a passive index fund investor who, it's emotional. You see yourself losing money, but this is a way to ground myself and feel like I'm making a little bit of money back and taking some control while still remaining consistent with my investing plan. And I'm also going to release a video today that talks about how to rebalance your accounts. And this is another great way to feel like you're buying at a low while selling at a high. So it's actually reversing a lot of the emotional makeup that we have when we invest, because typically inexperienced investors, what they'll do is they'll buy high because everybody's talking about how well the stock market's doing. So you get really excited, you get this greed kind of that you're going to make a lot of money. So you dump a bunch of money in and then the market tanks. And then what happens? They buy high when everybody's feeling confident. And then when there's fear everywhere, they're selling. And so you sell low, you buy high. That's not what we want to do. I'm actually trying to train myself in the opposite way. So when it's high, I'm kind of thinking, well, I'm not going to sell because I'm not trying to time the market, but I can kind of expect that these things go in cycles and it's going to go down, but I'll just keep going with my plan. And as it keeps going down, I'm going to keep buying more of it. And so I'm looking at it as an opportunity to invest in American companies or international companies at a cheaper price. So it's just a cheaper ticket to entry, and that's kind of what keeps me motivated when there's a lot of emotion in the market about fear of loss. So if this has been a helpful video on tax loss harvesting for you, I will continue to release videos weekly. I'm going to focus more on the market now just because there's so much going on, and I know it's kind of a hot topic, and for me as well. So in a way, it's a cathartic thing for me to release these videos because I get to get some of the energy out that I have in the market. So one reminder, if you like this video, please like and subscribe. So that tells me that I'm creating content that's helpful for you. And then I also release a weekly newsletter. So you can find the link in my description below. It's a free newsletter, and I'll release content from budgeting, saving to investing, everything that kind of centers around the mindsets of money and how to build wealth. So in my next video, I will talk about account rebalancing. So I don't have it out yet, but if you're watching this from the future, that video might pop up over here in a minute. So thanks for your time.